If you have a 529 plan, you probably file it under college money. Starting in 2026, the K-12 rules get bigger, and also easier to mess up if you don't track one limit. By the end of this video, you'll be able to do 3 things. You'll know the new K-12 529 cap and what it covers. You'll be able to run a quick qualified or not test on any expense without guessing. And you'll know exactly what to check so you don't accidentally turn a clean withdrawal into a taxable one. Quick note, this is education, not personal financial advice. State plan rules and your tax situation can change details. Let's use one scenario, all the way through. You have a 5th grader in private school. Tuition is $18,000 for the year. You also pay tutoring, about $250 a month during the school year, and maybe $600 on testing and application fees. You have money in a 529 and you hear, the K-12 limit is higher now, so you're good. Here's the first trap. The limit is not a vibe, it's a cap. Starting January 1st, 2026, the annual federal limit for K-12 expenses paid from a 529 increases from $10,000 to $20,000 per student. If you stay within the cap and the expense is qualified, the earnings portion of the withdrawal is intended to stay federal tax-free. If you go over the cap or you pull money for something that is not qualified, the earnings portion of the non-qualified part can become taxable, and the usual federal 10% penalty on earnings can apply. Notice the phrasing, earnings portion, not your contributions. A withdrawal is usually a mix of what you put in and growth. When something is non-qualified, it's typically the earnings piece that takes the hit. So, how painful a mistake is depends on how much growth is in the account and how big the non-qualified slice is. Now, make the cap real with our scenario. Tuition is $18,000. Under the old rule, the IRS has described K-12 eligibility as up to $10,000 a year in K-12 tuition per student. Under the new 2026 cap, $18,000 of tuition can fit, and you have about $2,000 of headroom. That's where the second trap shows up. School stuff is not the same as qualified. Some sources describe an expanded K-12 list that can include items like tutoring and certain testing costs under recent law changes, but the safe way to treat this is simple. Do not assume. Check the current list your plan points to, and then check whether your state conforms to the federal definition for state tax benefits. Here's the 2-step test. Step 1 is the federal bucket test. Is this a K-12 qualified expense under current federal rules? Step 2 is the state conformity test. Even if it's federally qualified, does your state treat it the same way? Or could you face state tax recapture? Now look at the math that catches people. If you withdraw $18,000 for tuition, plus $2,250 for tutoring, plus $600 for testing, that's $20,850. Even if every category is qualified, you are still over the $20,000 annual cap by $850. That $850 becomes the problem slice. So the clean workflow is cap first, then category, then timing, then receipts. Timing matters because the cap is annual. Many families pay tuition in 1 month and withdraw in another. Your simplest rule is to match withdrawals and qualified expenses in the same calendar year. Now, the documentation trap, which is where people get surprised even when they stayed under the cap. A 529 plan does not know what your withdrawal was for. It only knows you took a distribution. If a question ever comes up, you need to show that your qualified expenses match your withdrawals for that year. So here is the one place to look today. Open your 529 portal and find your distribution history. It will show the amount, date, and destination. Compare your year-to-date distributions for that student to a folder of receipts you can actually defend, like tuition invoices and proof of payment, plus any other categories you're claiming. In our scenario, if you withdraw $20,000 in 2026, you want to be able to point to $20,000 of qualified K-12 expenses in 2026 for that student. If your receipts add up to $19,200 because you forgot to save a tutoring invoice, you just created a gap you can't easily explain later. Now, because most people don't do one clean annual withdrawal, the best model is a simple tracker. For each student, keep a running total for the calendar year. Add every 529 distribution you take for K-12. Next to it, Keep a running total of qualified expenses paid that year. After an $18,000 tuition withdrawal, your totals are $18,000 and $18,000. If you later withdraw $1,000 for tutoring, your totals are $19,000 and $19,000, and you know you have roughly $1,000 of cap left for 2026. That's the practical win. You stop guessing. One more practical detail before we move on. How you route the money can change how easy the paperwork is. Some plans let you send the distribution straight to the school, and some send it to you. Either can be fine, but if the money comes to you, it is easier to accidentally mix it with other spending. If the money goes to the school, it is easier to line up the transaction with a tuition invoice. The trade-off is flexibility. Paying yourself can help when you already paid out of pocket and you're reimbursing yourself later, but then your receipt folder has to be clean. Also, expect tax forms to be confusing even when you did everything right. A 529 distribution can trigger a Form 1099-Q that reports total distributions and the split between basis and earnings. That form does not say qualified or not qualified. It is just a report. Your job is to make your receipts and your year totals tell a simple story. Next, we'll lock in 3 concrete signals to watch so you don't get blindsided by rule updates, state conformity surprises, or a tax form that doesn't match your story. Let's make this actionable with 3 signals you can watch. Not vibes, not guesses. 3 things that tell you, early, whether your K-12 529 plan is about to get messy. Signal 1 is the running total for that student for that calendar year. Where to look. Your 529 portal distribution history. Filter to the student if your plan supports it, then filter to the year. Add up every K-12 distribution you took in that calendar year. What direction matters? If you are approaching $20,000, you are on cap watch. If you are over $20,000, you are in reconcile now mode because part of what you pulled is no longer eligible under the federal K-12 cap starting in 2026, chase.com. Typical timing. This shows up immediately because it's just math on your own withdrawals. It is the earliest warning system you have. Back to our 5th grader. You pull $18,000 for tuition in January. That's fine. In April, you pull $1,500 for tutoring reimbursement. Now you are at $19,500. You still have headroom. But the next $750 withdrawal matters a lot more than the first $18,000 did. Here's the decision rule tied to signal 1. If your year-to-date total is under $18,000, you have room to breathe. You still want receipts, but you're not flirting with the edge. If your year-to-date total is between $18,000 and $20,000, treat every next withdrawal like it needs a receipt and a category check before you click submit. If your year-to-date total is at $20,000 or above, pause and reconcile. Do not keep pulling and hope it works out later. The cap is annual, so there is no catch-up that makes the extra amount qualified after the fact. Signal 2 is whether your expenses are truly in the qualified bucket you think they are. Where to look. Your plan's K-12 qualified expense list and the plan disclosure materials for your state's treatment. This is usually in the plan website, plan disclosure statement, or a FAQ that links you to the definitions they use. What direction matters? If the language is explicit and it matches the category you want, you can treat it as a qualified expense candidate. If the language is vague or the category is not listed, don't assume it is qualified just because it feels education related. With 529s, intent does not convert an expense into a qualified one. The definition does. Typical timing. This shows up at the moment you are about to withdraw. It's a pre-withdrawal check, not a tax season check. Back to our 5th grader. Tuition is straightforward, and it usually maps cleanly. Tutoring is where families get casual. Some sources describe expanded K-12 lists under the 2026 changes, but your safest workflow is still. Look up the category, then decide. Chase.com. If your plan clearly treats a tutoring expense as qualified under the federal K-12 definition it follows, then you can include it in your receipt folder. If not, you have a choice to make, and it's not a moral choice. It's a trade-off choice. Here's the decision rule for Signal 2. If the expense is clearly listed as qualified and you are under the $20,000 cap, a 529 withdrawal for that expense is generally consistent with the intent of the program. If the expense is not clearly listed and you still want to pay it, one option some people consider is paying out of pocket and saving the $5.29 for the cleanest categories, like tuition. Another option some people consider is getting clarity directly from plan materials or a qualified tax professional before treating that category as $529 qualified. The point is not to be paranoid. The point is to avoid accidental non-qualified slices that only show up later when you are tired and doing taxes. Signal 3 is the mismatch risk between your withdrawals and your paid expenses inside the same calendar year. Where to look? 2 places: your year-to-date 529 distributions and your year-to-date paid invoices or receipts for that student. What direction matters? If distributions are higher than documented qualified expenses, you have a gap. That gap is exactly where the "this could be non-qualified" headache lives. Typical timing. This risk often shows up mid-year when payments are uneven. One big tuition withdrawal in January, then scattered smaller expenses later, or reimbursements that happen in a different month than the invoice. Back to our 5th grader. You withdrew $18,000 for tuition in January. Great. Then you withdrew $2,000 more in November because you remembered you still had cap room. The problem is, do you have $2,000 of qualified K-12 expenses paid in 2026 that match that November withdrawal? If you do, clean story. If you don't, you can't fix it with a story. You can only fix it with documentation, or by not making the withdrawal in the first place. This is where a lot of people get tripped up by how tax reporting feels. A 529 distribution can be reported on Form 1099-Q. It breaks out the distribution into basis and earnings. It does not certify that your expense was qualified. It's a report of what left the account. Your job is to make sure your expenses, for that year, support that distribution. IRS.gov. So, let's put all 3 signals into one clean playbook you can follow without turning this into a second job. First, decide the cap strategy early. In our scenario, tuition is $18,000. If you want to keep this simple, you can treat tuition as the core category and reserve most of the cap for it. That leaves $2,000 of cap room for the year. Second, pick your withdrawal style and stick to it. Option A is direct tuition payments from the 529 to the school if your plan allows it. The upside is that the paper trail is clean. The money goes to the school and the invoice usually lines up. Option B is reimburse yourself. The upside is flexibility. If you paid tuition or tutoring out of pocket, you can reimburse later. The downside is that you must be disciplined about receipts and timing because the money hits your checking account and can blend into everything else. Third, set a cap checkpoint date. This is not a calendar gimmick. It's a real safeguard. Pick one date each month, like the last Sunday, and do a 90-second check. Year-to-date distributions for that student. Year-to-date qualified expenses documented. Compare. If distributions are higher, stop withdrawals until you close the gap. Now, the "so what" that intermediate viewers care about. The cap increase to $20,000 looks like a relief, but it also makes the edge cases more common. Under $10,000, many families never touch the cap and never had to track it. At $20,000, more families will use the full amount, which means more people will end up near the line where one extra withdrawal or one missing receipt creates a non-qualified slice. And there's a second-order effect. If you are taking a state tax deduction or state tax benefit tied to your 529 contributions, the state may have its own rules about what counts as qualified. Even when something is federally qualified, state treatment can differ. Your plan materials usually tell you how your state handles it. And that matters because the pain of a mistake can be more than just federal taxes. This is why the state conformity check is signal 2, not an optional footnote. Let's finish by running our scenario through a clean year. January. Withdraw $18,000 for tuition. Save the tuition invoice and proof of payment. February through May. Tutoring happens. You keep invoices in a folder, but you do not withdraw yet. June checkpoint. You verify tuition is documented, and you decide whether tutoring is a qualified category based on plan materials. If it is, you plan withdrawals later. If it's not clear, you pay tutoring out of pocket and you keep your 529 cap focused on tuition only. November checkpoint. You have $1,600 of clearly qualified expenses beyond tuition documented, and you are still under the $20,000 cap, so you withdraw $1,600 and the story stays clean. That's the feeling you want, not "I hope this is fine." You want "I can prove this is fine." Now, the 2-minute checklist. If you do nothing else, do these. Open your 529 portal and write down year-to-date distributions for that student. Write down the K-12 cap for 2026, which is $20,000 per student per year. List the expenses you plan to pay from the 529 and confirm each category in your plan's K-12 qualified list. Match withdrawals and qualified expenses inside the same calendar year. Do not mix years casually. Save receipts in one folder per student per year. Tuition invoice, proof of payment, and any other qualified categories you used. If you reimburse yourself, keep the reimbursement trail clean, receipt, withdrawal date, and the bank deposit record. If you are within $2,000 of the cap, treat every new withdrawal as verify first, then withdraw. If your withdrawals exceed your documented qualified expenses, pause withdrawals and reconcile before you take more. And if a tax form shows up and looks scary, remember the core rule. The form reports the distribution. Your receipts prove whether it was qualified, irs.gov. That's the whole game. Track one limit, confirm the category, keep the story clean. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns. And leave a comment with the next topic you want covered, or the one part of today's video you want explained even simpler.